Have you ever wondered how non-Nigerian companies engage in transmitting messages through cables or wireless devices are taxed? Or how the intricacies of taxation apply to insurance companies in Nigeria, from profit calculation to segregation of life and general insurance businesses? In this video, we will delve into Section 15 and Section 16 of Companies Income Tax Act to unravel these complexities. As usual, we will be giving literal interpretations, insightful analysis, and illuminating case studies to clarify these sections. So buckle up. Hi, my name is Olatunji Abdulrazak. I am the founder and CEO of TaxMobile.online. Welcome to my YouTube channel, A Stitch in Tax Saves Cash. This channel is dedicated to helping you stay on top of your taxes. We will provide you with tips and strategies to help you keep more money in your pockets and minimize your tax liability while you stay in compliance with tax laws. So, if you want to start taking control of your finances from today, hit the subscribe button below and click the notification bells to stay updated on our latest videos. Section 15, Cable Undertakings. Where a company other than a Nigerian company carries on the business of transmission of messages by cable or by any other form of wireless apparatus, it shall be accessible to tax as though it operates ships or aircraft, and the provision of the preceding section shall apply mutatis mutandis to the computation of its profits deemed to be derived from Nigeria, as though the transmission of messages to places outside Nigeria are equivalent to the shipping or loading of passengers, mails, livestock, or goods in Nigeria. Section 16. Insurance companies. An insurance business shall be taxed as general insurance company, whether proprietary or mutual, other than a life insurance company or a life insurance company, provided that the profits on which tax may be imposed for an insurance business shall be in accordance with Section 13 of this Act. For a general insurance company, the profit on which tax may be imposed shall be ascertained by taking the gross premium and other income receivable less reinsurance and deducting from the balance so arrive at a reserve for unexpired risk determined in accordance to Section 10A of this section. For a life insurance company, the profits on which tax may be imposed shall be the investment income less the management expenses including commission. Any amount distributed in any form as dividend from an actuarial revaluation of unexpired risk or from any other revaluation shall be deemed to be part of the total profits of the company for tax purposes. Not more than 3 months after an actuarial revaluation of unexpired risk or any other revaluation has taken place, the company shall provide the service with full particulars of the revaluation carried out, including a copy of the actuary revaluation certificate. The profit on which tax may be imposed in a general Nigerian insurance company shall be ascertained in accordance with the provision of subsection 2 as though the whole premium and investment income of the company were derived from Nigeria, and in a Nigerian life insurance company shall be ascertained in accordance with the provision of subsection 3, 4, and 5 as though the whole investment and other incomes were received in Nigeria and all the expenses and other outgoings of the company were incurred in Nigeria. Investment income for the purpose of taxation of a life insurance company under this section means income derived from investment of shareholders' funds. Where an insurance company carries on a life class and a general or non-life class insurance business, the funds and books of account of one class shall be kept separate from the other as though one class does not relate to the other class, and the annual tax return of the two classes of insurance business shall be made separately. Each class of insurance shall be assessed separately as life insurance assessment and non-life other insurance assessment, and in respect of each class of insurance business where there are more than one type of insurance and in the same class they form one type of business and shall not be allowed against the income from another type of insurance business, but the loss shall be available to be carried forward against profit from the same class of insurance business. An insurance company other than a life insurance company shall be allowed as deduction from its premium the following reserves for tax purposes. Reserve for unexpired risks calculated on a time apportionment basis of the risk accepted in the year, and for outstanding claims and outgoings, an amount equal to the total estimated amount of all outstanding claims and outgoings, provided that any amount not utilized towards settlement of claims and outgoings shall be added to the total profit of the following year. An insurance company, in respect of its life insurance business, shall be allowed the following deduction from its investment incomes and other incomes: an amount which makes a general reserve and fund equal to the net liabilities on policies in force at the time of an actuarial valuation; an amount which is equal to 1% of gross premium earned or 10% of profits, whichever is greater, to a special reserve fund and accommodation until it become the amount of the statutory minimum paid up capital and all allowable business outgoings. A reinsurance company shall be allowed the following deduction from its gross profit to be credited to a general reserve fund: an amount not more than 50% of the gross profit of the reinsurer for the year where the general reserve fund is less than the initial statutory minimum authorized share capital, or an amount not more than 25% of the gross profit of the reinsurer for the year where the fund is equal to or exceeds the initial statutory minimum authorized share capital. An insurance company that engages the services of any insurance agent, a loss adjuster, and an insurance broker shall include in its annual tax returns a schedule showing the name and address of that agent, loss adjuster, and insurance broker, the date their services were employed and terminated as applicable, and payments made to each such agent, loss adjuster, and insurance broker for the period covered by the tax returns. The provisions on minimum tax in Section 33 of this Act shall apply to insurance business, provided that gross turnover shall mean gross premium and other income in the case of non-life insurance business and gross income in the case of life insurance business. For the purpose of subsection 14, gross premium means the total premiums written, received, and receivable, excluding unearned premium and premiums returned to the insured. Gross income means total income earned by a life insurance business, including all investment income, excluding frank investment income, fees, commission, and income from other assets, but excluding premiums received and claims paid by reinsurers, and other income for the purpose of non-life insurance business means all the income of the non-life insurance business other than gross income, excluding frank investment income. Let's start with the interpretation, analysis, and case studies of section 15. The literal and simple interpretation. This section of the law states that if a company that is not based in Nigeria is involved in sending messages through cables or wireless devices, it will be taxed as if it were operating ships or aircraft. This means that it will be treated as having derived profit from Nigeria, similar to how a transportation company profits are determined. Analysis. The provision implies that the profits derived from the transmission of messages to places outside Nigeria will be considered as if the company business activities were physically carried out within Nigeria. Essentially, it extends the tax treatment applicable to transportation companies to companies engaged in the transmission messages via cable or wireless apparatus. Case studies. Case study 1. XYZ Communication is a multinational company that provides cable-based messaging services to customers in Nigeria and other countries. According to the law, XYZ Communications will be taxed as if it were operating transportation vehicles within Nigeria, even though its actual operations are based on message transmission through cable. Case study 2. ABC Wireless is a foreign company that uses wireless apparatus to transmit messages globally, including to and from Nigeria. Under this law, ABC Wireless will be subject to taxation as if it were conducting its business operation within Nigeria, similar to how a transportation company profits are determined for tax purposes. Now, let's go on to the interpretation, analysis, and case studies of section 16, subsection 1 to 9. Literal and simple interpretation. This section of the tax law specifies how the profits of both general insurance companies and life insurance companies should be calculated for tax purposes. It also outlines the requirement for separating accounting of life and general insurance business and the treatment of profit and losses in each class of insurance. Analysis. Taxation of insurance company. The section outlines that the profit on which tax may be imposed for an insurance business, be it a general insurance company and life insurance company, shall be calculated according to the provisions of the Act. Calculation of profit. For general insurance companies, the profit on which tax may be imposed is determined by taking the gross premium and other income receivable less reinsurance and deducting a reserve for unexpired risk. For life insurance companies, the profit subject to tax include investment income less management expenses. Treatment of dividends. Any amount distributed as dividend from an actuarial revaluation of unexpired risks or any other revaluation is considered part of the total profit of the company for tax purposes. Separation of life and general insurance business. If an insurance company carries on both life and general insurance business, the funds and books of account of one class must be kept separate from the other, as the profit and loss of each class of insurance business are treated independently for tax purposes. Assessment and losses. Each class of insurance business is assessed separately, and any losses incurred can be carried forward against profit from the same class of insurance business. Case studies. Case study 1. General Insurance Company. ABC General Insurance Company operates in Nigeria and provides various types of general insurance policies. To calculate the profit subject to tax, the company would take the total gross premiums and other income, subtract reinsurance, and then deduct a reserve for unexpired risk. The resulting amount would be the taxable profit for the general insurance business. Case study 2. Life Insurance Company. XYZ Life Insurance Company operates in Nigeria and generates income from investment of shareholders' funds. The taxable profit for the life insurance business should be the investment income less management expenses, including commission. Case study 3. Mixed Insurance Company. DEF Insurance Company operates both life and general insurance business. The company must keep separate funds and books of accounts. Each class of insurance would be calculated and assessed separately for tax purposes. Now, let's go on to the interpretation, analysis, and case study of section 16, subsection 10 to 14. Literal and simple interpretation. The law allows deduction for certain reserves and funds for both general and life insurance companies. Non-life insurance companies are allowed to deduct reserves for unexpired risk, outstanding claims, and outgoings. Life insurance companies are allowed deduction for a general reserve and fund, a special reserve fund, and normal business outgoings. Reinsurance companies are allowed deduction for a general reserve fund. The law also mandates insurance companies to include a schedule in their annual tax returns showing payments made to insurance agents, loss adjusters, and brokers. Additionally, the minimum tax provision applied to insurance businesses. For non-life insurance, it's based on gross turnover, and for life insurance, it's based on gross income. Analysis. The provisions outline the specific deductions allowed for different types of insurance companies in Nigeria. For non-life insurance companies, the deduction includes reserve for unexpired risk and outstanding claims and outgoings. For life insurance companies, the deduction involves general and special reserve funds and normal business outgoings. The law also set out the deductions applicable to reinsurance companies for their general reserve fund. Insurance companies must provide detailed information on payments made to insurance agents, loss adjusters, and insurance brokers in their annual tax returns. The law also explains how minimum tax applies to insurance with different rules for non-life and life insurance. Case studies. Case study 1. Non-life insurance company. Consider ABC Insurance, a non-life insurance company operating in Nigeria that accepts insurance premiums for various risks in a given tax year. Under the tax law provisions, ABC Insurance can deduct reserves for unexpired risk based on the time apportionment of the risk accepted in the year. Additionally, it can deduct an amount for outstanding claims and outgoings provided any unused amount is added to the total profit of the following year. Case study 2. Life Insurance Company. XYZ Life Insurance is a life insurance company in Nigeria, and according to the tax law, it is allowed to deduct certain amount from its investment incomes and other incomes. This includes the creation of a general reserve and fund equal to the net liabilities on policy in force and amount for a special reserve fund and normal business outgoings. Case study 3. Reinsurance company. DEF Reinsurance, a reinsurance company in Nigeria, can deduct amount for a general reserve fund based on the level of gross profits as permitted by law. If the general reserve fund is lower than the initial statutory minimum authorized share capital, a specific percentage of the gross profits can be credited to the general reserve fund. Interpretation, analysis, and case studies of section 16, subsection 15. Literal and simple interpretation. Gross premium is the total amount of premiums received and receivable by an insurance company, excluding any premiums that have not yet been earned or have been returned to be insured. For a life insurance business, gross income encompasses all income earned, including investment income, fees, commission, and income from other assets, but it excludes premium received and claims paid by a reinsurer. Additionally, other income for non-insurance businesses include all income apart from gross premium. Analysis. The definition provided in the statement are crucial for understanding the treatment of different types of income and premiums in the context of taxation for insurance businesses in Nigeria. It distinguishes between gross premium, gross income, and other income, providing clarity on the component of income and premiums considered for tax purposes. Case studies. Case study 1. Gross premium. XYZ General Insurance writes a total of $1 million in premiums during the year. Out of this amount, $100,000 represent unearned premiums and $50,000 is returned to policy holders. The gross premium for tax calculation purposes would be $1 million less $100,000 less $50,000, which is equal to $850,000. Case study 2. ABC Life Insurance generates a total income of $2 million during the tax year, including $500,000 from investment income, $300,000 from fees and commission, and $200,000 from other assets. However, it received $150,000 in premiums and paid $100,000 in claims through reinsurers. In this case, the gross income for taxation purposes will be $2 million less $150 less $100,000, which is equal to $1,850,000. Case study 3. Death Property Insurance accumulates a total income of $1.5 million, excluding $600,000 in gross premium. This income is derived from various sources such as investment returns, service fees, and income from other assets. The other income for tax purposes will be $1.5 million less $600,000, which is equals to $900,000. In summary, this provision of Section 15 ensures fair taxation for non-Nigerian companies transmitting messages, aligning their tax treatment with local transportation companies to guarantee compliance and revenue generation. And Section 16 provides guidelines for the taxation of insurance companies, ensuring the accurate taxation of both general and life insurance companies' profits. By understanding and adhering to these provisions, both businesses and regulatory authorities can promote tax compliance and effective revenue generation. Thank you for joining us on this enlightening journey. If you have any questions or want to share your thoughts, feel free to drop them in the comments below. And if you found this video helpful, don't forget to like, subscribe, and hit that notification bell for more insightful content. Also remember to watch our previous videos.